This isn't speculation, it's pattern recognition. And if history follows its rhythm, and it always does, we have about 18 months left before the system reaches its breaking point. 18 months. That's exactly how long it took the last time, in 1929, for markets to fall from euphoria to devastation. Back then, from the moment the first cracks appeared to the day the Dow had lost almost 90% of its value, the clock ticked the same way, month by month, step by step. And the scary part? That same clock just started again. September 1929. The Dow Jones Industrial Average closes at 381.17, the highest it had ever been. Optimism fills the air. Newspapers praise the new era of prosperity. Economists claim stocks have reached a permanently high plateau. But beneath the surface, the smart money was already leaving. People like Joseph Kennedy and Bernard Baruch, legendary investors, had seen this movie before. They understood the math of margin debt. When everyone is buying stocks on borrowed money, even a 10% dip can wipe out an entire position. And once those positions get wiped out, brokers sell automatically. Prices drop further. That triggers more selling, and the cycle spirals until the leverage burns away. By September 1929, corporate insiders, executives and directors were quietly liquidating 50, 60, sometimes 70% of their holdings. They weren't diversifying. They were escaping. Earnings had already peaked. Factory orders were falling. Commodity prices were slipping. But the stock market kept climbing anyway. That's stage 5. The phase where logic no longer matters, where prices rise purely on belief. Fast forward to November 2025. We're standing in the same place investors were in September 1929. The parallels are almost eerie. Insider selling is at record levels. Margin debt is just shy of 8% of GDP, the same red zone threshold that preceded every crash in modern history. Warren Buffett, one of the most cautious investors alive, is sitting on $325 billion in cash, the largest war chest Berkshire Hathaway has ever held. And valuations? Detached from earnings in a way that defies basic math. Every sign points to the same conclusion. Stage 5 has begun again. And if the timeline repeats, and it so far is perfectly aligned, that means the countdown ends around May 2027. That's when the biggest transfer of wealth will occur. From the over-leveraged and overexposed to those sitting patiently on the sidelines with cash and courage. Let's rewind to see how the Great Crash actually unfolded. Because the pattern didn't happen overnight. It unfolded month by month, just like what we're about to experience. October 1929. The crack appears. The market gets shaky. Prices bounce wildly. Big trading days with heavy volume, the kind that screams distribution. Smart money unloading on the crowd. Then, on October 18, the market plunges. Recoveries follow, but they're weak. By October 23rd, panic sets in. Bankers step in, J.P. Morgan, National Citibank, the Titans, pledging to stabilize the market. Newspapers cheer, crisis averted, headlines say. But it's only the calm before the storm. Because over that weekend, margin calls flood mailboxes across America. October 28th, the Dow falls 13% in a single day. October 29th, Black Tuesday, another 12% gone. A quarter of the market's value wiped out in 48 hours. But that wasn't the bottom. It was the beginning. After the panic came stability. For a few weeks, it even looked like recovery. By December 1929, people were saying the worst was over. Advisors told clients to buy the dip. Newspapers printed words like healthy correction. But behind the curtain, the damage was spreading. Banks had lent against inflated stocks, and now those loans were going bad. Credit tightened. Layoffs began. Factories slowed. By early 1930, unemployment was rising fast. Yet, the public still believed. They thought the crisis was contained to Wall Street. That's how stage 6, the unwinding, quietly begins. Month after month, the market sank lower, not in spectacular crashes, but in slow, grinding declines that wore people down psychologically. Every rally fizzled. Every headline promising recovery was followed by another drop. By mid-1930, more than 600 banks had failed. People lost their savings. Businesses couldn't get loans. Farmers couldn't sell their crops. The economy imploded. And by March 1931, 18 months after the top, the Dow was down nearly 60%. Not the bottom, but close. The remaining 30% drop, the final capitulation, came later, when everyone who still believed finally gave up. That's how it always ends. Now imagine overlaying that same 18-month timeline on today. If September 1929 equals November 2025, then the crack comes this winter around December or January, the false hope rally runs through early 2026, the slow grind lasts through the middle of 2026, the capitulation, the panic selling, arrives late 2026 into early 2027. Let's break that down month by month. This is your final window to prepare. If your portfolio is 80 to 90% in equities, cut it in half. Raise cash, move into short-term treasuries. Yes, the market might rise a bit more into December, but the math is simple. Protecting your capital from a 60% crash is worth missing a 5% rally. If you're holding speculative stocks, meme names, or overhyped tech with no earnings, this is the time to exit. These will be the first to collapse. Consider hedging. A small position in put options can serve as insurance. You buy it hoping you won't need it, but if the worst happens, it can save you. The first drop will be sharp, maybe 10 to 15% in a few days. Financial media will say, buy the dip. They'll call it a correction. They always do. Then you'll see a rally, prices recovering 10% or so. That's the dead cat bounce, the illusion of safety before the real storm. Use that bounce to finish de-risking. Don't mistake it for a recovery. In 1929, those who bought the first dip ended up losing another 80%. This is when the real test begins. Markets will drop slowly, relentlessly. Each new low will feel like the last, but it won't be. Unemployment rises. Earnings collapse. Credit tightens. Banks start reporting losses. Every small rally will fade. Every attempt at optimism will get crushed by another wave of bad data. By mid-2026, the indexes could be down 50%. Most investors will still be holding, telling themselves it'll bounce back. They'll be wrong. This is where everything accelerates. The slow bleed becomes an avalanche. Forced liquidation everywhere. Funds meeting redemptions, banks dumping assets, individuals selling just to survive. Nobody's buying. Unemployment hits double digits. Corporate bankruptcies surge. Famous companies vanish overnight. The headlines turn apocalyptic. And that's when opportunity returns. Because while most people are terrified, the patient few, the ones who prepared, start buying quietly. Quality companies with strong balance sheets, low debt, and real products. Names like Microsoft, Apple, Visa, Johnson & Johnson, not at record highs, but 70% off. That's how generational wealth is built, not by chasing bubbles, but by waiting for them to burst. If you're wondering how we know the clock has started, look at these 6 signals flashing red right now. Insider selling. Executives unloading shares at a 20-to-1 ratio over buys, the highest since 2007. Buffett's cash pile. $325 billion sitting idle, not in stocks, but in short-term treasuries. Margin debt at 7.9% of GDP, right where it was before every major crash in history. Valuations. The Shiller PE ratio hovering around 35, double its long-term average. Economic data. growth slowing, manufacturing contracting, corporate profits flattening, and regional banks quietly failing. Investor sentiment, unshakable confidence. Everyone believes the Fed can stop any crash. That's always the final illusion.
Put these together, and it paints one picture. Stage 5, confirmed. By the time March 2027 arrives, the pattern says the market could be down 60% to 70%. That's trillions of dollars erased, or rather, transferred. Because money doesn't disappear, it moves from the panic sellers to the patient buyers, from the over-leveraged to the liquid, from the unprepared to the prepared. That's how Joseph Kennedy multiplied his fortune after 1931. It's how Warren Buffett made billions after 2008. And it's how a small number of disciplined investors will build their legacies after this cycle ends. You can believe the headlines saying everything's fine. You can ride the wave a little longer, hoping this time is different. Or you can recognize the pattern, the same one that's repeated for centuries, and step aside before the tide goes out. Protect your capital now. Be patient. And when fear dominates the headlines, be ready to act. Because history rewards the few who prepare when everyone else ignores the signs. We're not predicting the future. We're just reading the rhythm of the past. And the rhythm says the clock started ticking in November 2025. That gives us 18 months until March 2027 before the cycle completes. What you do between now and then will determine which side of that transfer you end up on. You can be among those forced to sell in panic, or among those patiently buying at generational lows. The pattern has started, the countdown has begun, and the choice, as always, is yours.